Okay, so welcome to my second video. It's January 17th, 2023. With this video, I'm going to look at a macro overview of 2023, some major indicators. We're going to look at a bear case for 2023, a bull case. We're going to get the S&P 500 and Bitcoin primarily. So let's get started. Okay, so here we have the S&P 500. I just wanted to give you guys a few charts to get an overview of where we are at the beginning of January. So this is the S&P 500. You can see we're at about 4,000 as of last Friday. The red line there is the 200-week moving average. And you can see that, despite all of the negativity in sentiment, we still didn't break the 200-week moving average, and we're significantly above that now. So it looks like it's around 3,680 is the 200 MA, and we've held above that basically since as long as this chart goes back, except for the COVID drop there. It's a good sign. Bitcoin and crypto has rallied the last few days, so we've been up all of January, about 25 to 30%. Bitcoin's at 21,000 or so, and Ethereum is up. Most of the other markets up as well. Gold is close to breaking out. We're at about 1925 US dollars. With gold, we're going to hit an all-time high in USD fairly soon. We're seeing the US dollar weaken a bit, which is obviously a tailwind to the price. But also, if you look at other currencies, like here's the yen, you can see it's been going higher for quite some time. So it's not the case that gold is going higher simply because the US dollar is getting weaker, but rather gold's breaking out against all fiat. And so it should be a good year for gold. The US 10-year treasuries at 3.49%. You can see my cursor here. We had it peak above 4% in late 2022, but it's fallen since then. We're about 3.5. The bond traders, with regards to the 10-year, are saying that rates are not going much higher. Okay, so the 10-year being lower is predicting two or three things, and maybe all of them together. One would be we're having a recession soon, or rates are not going higher. So rates are not going higher either because we hit a recession and the Fed pauses, or we don't hit a recession, we have a mild recession, and because inflation's falling, Jerome Powell and the Fed stop raising rates as well. In either case, they're saying we're not getting higher rates, which is interesting. Oil prices are down. Again, my cursor is showing that the end of 2022, we hit a peak of about 130, and we've fallen a lot. We're at around 79 US dollars, maybe 80 US dollars. This is crude oil. What this is showing is that the global economy is slowing, obviously including the US economy, and that inflation should be coming down based on this slower growth. DXY, this is the US dollar against a basket of currencies like the euro and JPY. So again, we had a peak of about 114. Looks like that was September 2022, and it's fallen drastically. We're at 102 in early January. This is good for a number of reasons. It's also why gold is rising, but also for corporate earnings. You're going to see, we'll talk about this later on, but if corporate earnings are weakening, but the US dollar is falling, it gives it some support because repatriated earnings from outside of Japan, so from Europe, Japan, wherever else, coming back in because of the exchange rate into a weaker US dollar, you're going to get a support to profits and earnings. Okay. This is the big one. This is monthly US headline CPI. Okay, you can see this is 2022. We had the peak at 9.1% in June of 2022, but we've had it fall for 1, 2, 3, 4, 5, 6 consecutive months. We hit 6.5% in December. That came in last week, which was a big difference between the 7.1 in November. So inflation is indeed falling very quickly and will likely continue. We could see January somewhere in the 6 range, and Q1 falling even further. So this is great for again, a multiple number of reasons. The Fed wants to see this. If inflation is indeed falling and staying lower, it means the Fed doesn't have to be so hawkish. So we'll have less likelihood of the Fed rates going above 5%. And obviously, it's better for consumers to have cheaper prices. U.S. unemployment, you can't see because of the video there, but it's at 3.5%. It actually fell from November to December. So we're at, looks like, around 50-year historical lows. The issue here is that the bears are calling for a recession very soon. And there are indicators showing that, but you're probably not going to have that when you have the unemployment rate so low. So until we see a spike in the unemployment rate, a recession is unlikely. Currently, there's lots of jobs out there. People have their jobs. They can pay their mortgages. They can pay their car payments, and things are ticking along. Okay, but let's go deeper into the bear case for 2023. The bears would argue the global economy is slowing. Europe is in or near a recession. Energy prices are high. China is reopening, but it's on shaky ground. We don't know how strong the China recovery will be. They'll say inflation is still too high, energy prices are too high, and that the Fed is saying they're not going to pivot, they're not going to cut rates. So Jerome Powell is still talking about aggressively raising rates, and if inflation stays somewhat built into the system, that rates are just not coming down, right? And therefore, the stock market's going to go down, and there's going to be a negative loop, so to speak. They'd argue that the rate hikes in 2022 haven't hit the real economy yet. I would agree with that, but I think there's two sides to that. So the fact that the rate hikes haven't really impacted the real economy would say that when they do, yes, we may have some falling corporate earnings, for example, but inflation is going to fall even more. And so we could have a very low inflation rate fairly soon if we have that double effect of what's happening already and then the tightening having a further effect. Okay, the bears will also talk about the war in Ukraine, and that's continuing. It's not getting better. COVID, we could have a resurgence in China or other places. And then there could be other unforeseen events in 2023 that would just knock us off a cliff, so to speak. They would argue housing sales are falling. We'll look at a chart soon on that. The S&P is overvalued at these higher rates. Ps just need to fall. They're saying corporate earnings are going to fall soon in Q1 and Q2. That's going to result in corporate layoffs. A housing crash may occur. That plus the corporate layoffs caused the unemployment rate to spike. Unemployed people default on their mortgages, and this is compounded. Sorry, there's a typo there, but it's compounded and it becomes a negative feedback loop. And so that's what the bears are saying. So some charts here. The inverted yield curve is showing that the 1 and 2 year treasuries are higher than the 10-year. And this has always predicted a recession. That's true. You can see where my cursor is. Oops, let's go forward. You can see that we're hitting a very inverted yield curve, and this is not a good sign in terms of the historical data. Okay, existing home sales fell year over year, 35%. This is very large number. You can see we're at about 6 million down to 4 million. Note here that it's not that prices have fallen yet, but the volume of sales have fallen. And typically the volume of sales will go first and then prices fall. And that would be bad news for the economy, right? If people's the value of people's houses are falling, they feel poorer. So there's a negative wealth effect. People stop spending. You could have defaults increase and have a knock-on effect into other parts of the economy. Consumer sentiment is also low. This is not good. We're at 59.1 here. You can see historically we're at all-time lows. Consumer spending is 70% of the US economy, and if consumers are not confident, they don't spend. And so again, this affects corporate earnings. Okay, but let's go to the bull case. Inflation is falling fast. This is the big item to watch. It's falling fast, and this will continue, in my opinion. I think we'll see January lower and February lower again. And again, I would agree that the 22 rate hikes have not hit the real economy. This typically takes, sorry about that. This typically takes some time, maybe 6 to 12 months for the rate hikes to hit the real economy, but that is also going to push down inflation even more. So arguably inflation could be 3 to 4% by Q2, which would ensure that the Fed is not going to raise rates much higher. Okay. The oil price is saying the global economy is slowing, and also an indication that inflation is on its way lower rather than higher. Another argument is that prices have already fallen. So we had a big sell-off in tech stocks. The S&P fell to about 3,500. Bitcoin crypto sold off, so that we've had some sell-off already. At least the bulls would say that that's been enough. So they'd argue the Fed will likely pause at about 4.5 to 5%, either because inflation's going down and or we go into a recession. If we do go into a recession, the Fed may even cut rates. And so there's a few items to look at there. DXY, US dollars falling. Again, this is good for repatriated profits. It supports corporate earnings with the exchange rate. And it's also good for countries that have US dollar debt repayments. So most businesses outside of Japan, or let's say a lot of businesses, will have debt liabilities denominated in US dollars. And as the US dollar is falling, those debt repayments are more feasible. Whereas if you have a very strong US dollar, it's more difficult to pay those back. So a weak US dollar is generally speaking good for the global economy. Okay. US unemployment, as mentioned, is at 50-year lows. If people have their jobs, they do not default on their mortgages typically. If they don't default, you don't have forced selling and a sort of snowball effect of negative impacts. Again, the 10-year yield is saying that Fed rates are not going higher. So a soft landing is very possible, according to the bulls, that we get either no recession or a mild recession. The housing market doesn't crash. There is demand. So it is true that even though sales volume is falling with housing, that housing inventory is still fairly scarce. And you have millennials who are the prime house buyers at the moment are between the ages of 26 to 42 years old. It's a big cohort. These people have jobs and are potentially will be buying any price dips if we do see that. If the housing market holds, I think it's a strong argument for why we will not see a weak economy in 2023, or at least weak asset prices. Okay, so events to watch for in Q1 of 2023. Will inflation fall fast enough to ensure the Fed stops at 5% Fed rate maximum? So you want to watch for January, February, March inflation. And I expect it is going to fall quite quickly. Again, it's already on that trend going down. If the economy is weakening, the US economy is weakening and the global economy is weakening, we'll have more downward pressure on prices and inflation, which is good. Question 2, will corporate earnings stay reasonably strong? So this week, starting today, we're going to start getting the 2022 Q4 corporate earnings, and watch for that. Hopefully they hold up reasonably well. The bears are saying it's going to be horrible and that corporate earnings will suffer. There will be job losses and PE revisions. We'll have to watch for that. And again, I'm repeating myself, but the housing market is probably the biggest thing to watch for. It is in somewhat of a bubble because we've had interest rates so low for so long. And it is a lot of people's primary asset. If that is to fall, that can cause forced selling and a negative wealth effect. So watch for housing prices to either hold steady. Hopefully they don't fall too much. If they do, we don't want to see prices falling too quickly, or there could be big problems in 2023. Okay, so we're looking forward here at the S&P 500, a 2023 outlook. This is pure speculation, just for fun. It's not financial advice. But you can see I've got it marked today or yesterday, January 16th, S&P at 4,000, and then the 200-week moving average. So obviously the bears would be saying we're falling into a deep recession, maybe below 3,000 on the S&P, based on everything we discussed earlier in the video. A mild recession would be an S&P falling no more than 3,500 and then maybe bouncing back. And then the more bullish scenario is we don't have a recession. We stay at least above the 200-week moving average. The S&P holds and then goes higher. In no recession, mild recession, I think we end the year higher. If we do have a deep recession, we don't really have a predictive view of where that would go, because you could have a 2009, 2008 great financial crisis type scenario where you have a multiplier of negative momentum, the unemployment rate spikes drastically, and we have an extremely bad year. So we'll see. Bitcoin and crypto. So again, speculation. We've had a good start to the year. We're at 21,000. Some good signs to say that we're going to have a good year. Price indicators are all bottoming. I did another video on my channel that talks about several multiples showing we're in historical bear market lows. The on-chain metrics are good for Bitcoin. We have adoption. We have wallets accumulating. We have an all-time hash rate, and we've survived a lot of bad news, including FTX and Celsius and all the other CeFi businesses that blew up. All that said, we've rallied here. We could still go lower. Some of the risks remaining, we've got big problems with Genesis and the Gemini DCG fallout with Barry Silbert, so that's unresolved, and that could have caused forced selling of Bitcoin. The SEC regulation on altcoins being ruled as a security could be big. It depends on how aggressive they get, but that could come in Q1 or Q2. The Mt. Gox coins have not been released. It looks like that'll be around September. That would create sell pressure. And then we're still going to have another year of bad headlines with Celsius, Voyager, BlockFi, etc., FTX. We'll have court cases. We'll have bad news. I'm not sure the coins will come to market that fast, but you could have coins being released and then sold off. So there's still risks. That said, I think if we do get a low, it'll probably bounce. So a low of 10 to 12K Bitcoin is possible. You can see, we could drop and rally at the end of the year, or we could, inversely, we could rally from here and still have a retest of lows, either at the 20K or the 16K or lower. I think by the end of the year, December 2023, we will be above 30K. We'll just, based on the past bear markets, by December 2023, we'll have been 2 years from the all-time high. We have the halvening in spring of 2024. The other thing about Bitcoin is it doesn't have earnings, right? Which is both maybe a positive and a negative, but it gets priced on different metrics, so yeah, I think odds are we'll be higher by the end of the year. So again, not financial advice, but some fun predictions for 2023. I think most of the year will be volatile. There will be a lot of maybe up and down sideways movement, but a better year than 2022. Some basic price predictions: gold higher, $2,350 US. Bitcoin higher, maybe $35,000 US or higher. And I'm calling for the S&P to be above, which would be around maybe 4,200 or higher. And again, this is dependent on we don't have a deep recession, inflation falls, the Fed is not as hawkish as some people fear, and a lot of the factors that we talked through, or rather metrics, hold up. Okay, so thanks for listening, and I hope this was useful, and I look forward to your comments.